When people talk about increasing their allocation to cash, it's not necessarily the most popular advice, especially when the stock market appears to be on an upward trajectory. But let me break this down a little further, and perhaps change how you think about cash and its role in your investment portfolio. First, the concept of diversification is arguably the most powerful tool in investing. Yet despite its popularity, many misunderstand what true diversification really is. Take, for instance, the common situation where someone owns 50 different stocks across 10 sectors, ranging from semiconductors to consumer durables. That person might confidently say they're diversified because their investments are spread out across different industries. However, diversification doesn't just mean having many stocks. It's about spreading risk across different asset classes, not just sectors within one. In reality, if you only own stocks, you're far from diversified. The key to real diversification is holding assets that have minimal correlation with each other. That means you want different asset types that don't all move in the same direction when markets fluctuate. In calm times, stocks from different sectors may behave independently, but during a market panic, they often move in unison, typically downwards. This is why it's essential to diversify across multiple asset classes. What are those asset classes? They might include gold, bonds, real estate, cash, and more. Each reacts differently depending on the economic environment, and that's where the magic of diversification comes in. So what does this diversified portfolio look like? Here's one approach. 1. Gold. The surprising stability. Many people are surprised when I recommend having around 10% of your portfolio in gold. The common question I get is, if you believe gold is such a strong asset, why not put 50% or even 100% in it? Well, while I am a firm believer in gold's long-term stability, putting too much of your portfolio into a single asset, even one as reliable as gold, is risky. You never want to go all in on one asset, no matter how much faith you have in it. If I'm wrong, you won't lose too much at 10%. But if I'm right, that 10% allocation will provide a considerable buffer and potentially significant gains. 2. Cash. Misunderstood but crucial. Now let's talk about cash. Probably the most misunderstood and underappreciated asset in today's economic landscape. The first thing people say is, why hold cash? It earns almost nothing, while the stock market keeps going up. But that mindset overlooks the vital role that cash plays in a portfolio. Cash is the opposite of leverage. In times of high volatility, whether in the stock market or in other assets like gold, having cash significantly reduces the overall volatility of your portfolio. This means you can sleep better at night knowing that your overall risk is more balanced. Additionally, while inflation seems like a constant threat to cash, deflation is not something we should rule out, especially if we face a severe recession in the near future. In a deflationary environment, the purchasing power of cash actually increases, making it an invaluable asset. So don't think of cash as dead weight. Think of it as a way to maintain stability and optionality in your portfolio. Optionality, by the way, is one of the biggest benefits of holding cash. Imagine if I offered you the chance to buy into any asset class in the world when it was significantly undervalued. That's essentially what cash offers, the flexibility to act when opportunities arise. Warren Buffett is a master of this. He's known for keeping large amounts of cash on hand, waiting for the right moments to swoop in when assets are undervalued. In fact, as of today, Berkshire Hathaway's cash reserves are at an all-time high. So while most investors might think holding cash is a losing game because of inflation, Buffett knows that in the world of investing, timing and patience are everything. When everyone else is forced to sell during a downturn, having cash allows you to buy quality assets at bargain prices. 3. Stocks. A strategic approach that brings us to stocks. While stocks can offer high returns, you must be strategic in your approach, especially in volatile times. One sector I'm particularly interested in is energy. I've personally invested in renewable energy projects and understand their potential and limitations. For example, I own the largest non-commercial solar field in New England, and it produces about 7.5 kilowatts of power. But here's the thing. It only works in ideal conditions. When it's nighttime, snowing, or heavily overcast, the system doesn't generate power. The real workhorse behind renewable energy is not solar panels themselves, but the batteries that store the power. When we talk about scaling these technologies for entire cities, it's not practical. at least not yet. Solar and wind power are intermittent and not reliable enough for the kind of baseline power we need to sustain a modern energy grid. On a global scale, demand for energy is only increasing, and renewables, while helpful, aren't closing the gap fast enough. This is why traditional energy sources like oil, natural gas, and even uranium are still essential. Whether or not the climate conversation supports these industries, the reality is that we're not yet in a position to operate without them. In fact, I've spoken to high-level board members at major oil companies who admit privately that there's no way to meet current global energy demands without oil and gas. They just can't say it publicly due to political pressure. For investors, this creates an opportunity. The energy sector, especially oil companies, has been hit hard by negative sentiment, but fundamentally, we can't function without them. This makes them potentially undervalued. 4. Real estate and other assets. Next, let's talk about other asset classes like real estate and farmland. Residential real estate can still be a sound investment, especially in regions where housing demand outstrips supply. However, commercial real estate is much riskier in today's climate due to changes in how people work and shop. Farmland, on the other hand, is becoming one of the hottest asset categories. As global demand for food increases and arable land becomes scarcer, farmland offers a unique way to hedge against both inflation and deflation. The Federal Reserve's dilemma. Now we need to think about how macroeconomic factors play into all of this. The Federal Reserve is in a bind. To combat inflation, they have to raise interest rates and reduce the balance sheet. But doing so could send the economy into a severe recession. If they continue tightening, we could see a significant downturn in the stock market and a recession that could be much worse than what people are prepared for. The last time the Fed tried to normalize rates was between 2013 and 2020. They started tapering asset purchases, raising rates, and attempting to shrink the balance sheet. What happened? In late 2018, the stock market plunged 20% in a matter of weeks, what's now known as the Christmas Eve massacre. It wasn't until early 2019 that the Fed realized the damage they were doing and started cutting rates again. But by then, the pandemic hit in 2020, and they had to drop rates back to zero and start printing money like crazy through quantitative easing, QE. The result? The balance sheet ballooned to $7.5 trillion. The Fed's inability to normalize rates in the last decade highlights the problem they face today. If they try to tighten too quickly, they risk crashing the market. But if they don't tighten enough, inflation could spiral out of control. We are walking a very fine line here, and as investors, we have to stay alert to the signals along the way. Gold's role in all of this. Let's circle back to gold. This is the third great bull market in gold that we've seen since 1971, when the U.S. abandoned the gold standard. In the first bull market, from 1971 to 1980, gold went up 2,700%. The second bull market, from 1999 to 2011, saw gold rise 670%. Now we're in the third, which started in December 2015 when gold was trading at around $1,050 an ounce. Since then, it has risen nearly 90%. But here's the key. Historically, these bull markets in gold go much higher, often between 600% and 2,000% increases. If the current bull market follows a similar trajectory, we could be looking at gold prices of $15,000 an ounce by 2025. Does this mean gold prices will only go up from here? Not necessarily. Gold is volatile and will likely see periods of decline, but the long-term trend is clear. For those who have yet to invest in gold, it's not too late. Even if you think you've missed the boat because gold has already gone up 90%, keep in mind that we may only be at the beginning of this bull run. In conclusion, cash, gold, stocks, and energy all play crucial roles in a well-diversified portfolio. The world is changing fast, and as investors, we need to stay flexible, informed, and prepared for multiple economic outcomes, from inflation to recession and even deflation.